What's up, everyone? Happy Thursday. Welcome back to NYU Grads Daily Podcast. A lot to cover today. We actually may go over the 15-minute target runtime, and I might drop a few F-bombs. So if you have kids that listen, if you're in a car listening to the podcast or on your speakers at home, you might want to put in your headphones or just hit pause and listen to this at another time. Lots to cover today. I don't want to digress from the format, so let me jump into breadth real quick and start from the top. So today we had 410 new highs and we had 177 new lows. That doesn't really tell much of the picture, right? If you've looked at the tape, if you looked at CNBC, the markets were crazy up today. You had 72% of shares advancing, 24% of shares declining. When you take a look at the 50-day moving average, you have 35% of shares beneath its 50-day. When you take a look at the 200-day, you have 34% of shares below the 200-day. So not much change from yesterday when you take a look at headline breadth numbers, but I would say that today was pretty much an orgy of bull fest going into the close. Even pre-lunchtime, like around 11:40ish, breadth started to expand after a attempt to sell off, and mostly the Magnificent Seven, as well as the Dow components, all lifted higher. So when you take a look at percentage-wise, yes, the NASDAQ and the S&P led percentage-wise 1.3 and 1.25%, but the Dow is also up 0.97%. Keep in mind, we had a lead up into earnings tonight for Amazon, Facebook, and Apple. And everything started to rally into the close in anticipation of those earnings. I don't know if the numbers leaked. I don't know if it was true anticipation, but breadth expanded markedly. And I want to also shout out to the misfits at slopeofhope.com, especially Vulcan, who had posted yesterday that we may just snap back and undo all of the sell-off from Wednesday. And that's basically what happened today. Quite amazing. And I'll go through some of this. But I digress. Let me keep going here. I don't want to go off script because if the NC-17 part of this call or this podcast, if you want to tune out, I want you to at least get the original flavor format. So Microsoft was up 1.5%. This is all percent, okay? I always deal with percent. Nvidia was up 2.44. Google was up 0.6. This is all before market close. Meta was up 1.9. Apple was up 1.3. Amazon was up 2.6. Tesla was up 0.84. Everything was green. There were some banking shares that were red, like JP Morgan was down 0.36. Bank of America down 1.3. Wells Fargo down 2.89. And you had New York Community Bank, who took over the assets of Signature Bank when the whole SVB fiasco collapsed. They were down again almost 10% today after being down 40% yesterday. So there's definitely some smoke coming from that part of the forest. So that was generally what happened between the start and finish of the session, okay? A few housekeeping items. I got an email from Substack, and they're doing their, I think they do this like once a month where they do shout out threads. So whether you're a pledger or just a subscriber, I would really appreciate if you go over to the link that I'll post in the show notes and just quickly recommend the podcast and the Substack and why. I would highly appreciate it. It would take 2 minutes of your time, but nonetheless, I would be very grateful. The end goal is to grow the community, find more like-minded traders and investors like us, and just to help more folks in the algorithm find the NYU Grad podcast and Substack. So I'll cover the earnings in a bit. I was actually on. So if you follow me, I've posted quite a bit of videos and links out to Adam Taggart's Thoughtful Money, and even when he was back with Wealthy On. And I just love his content. I think when you look at like Mamba mentality and you look at mastering your craft, he really knows how to interview people, and you could tell he does his subject matter research before the interview. And I rarely see him come to an interview unprepared or underprepared. So definitely check him out. And in a few days, he's going to release a video with Axel Merck, who's the president and chief investment officer of Merck Investments, which he's obviously the proprietor of. And it was a great episode. It's not available for free subscribers. It's only available for premium right now. But the reason I'm bringing this up is during one of the Q&A, I had to leave to help my wife with something. And if Adam, if you're listening, I love the compliment you gave me. He basically said I have a lot of moxie, I'm a young trader, and I love it. That's the energy I want to give out. But in my soul, I am a run-down New Yorker. I'm very cynical. I was a class of 99 at NYU Stern. I grew up in New York, latchkey kid, immigrated from an Asian country, just to kind of stay a little bit anonymous here. Was raised by a single mother for a majority of my life in New York. And just, I had to show a lot of grit to succeed. And it dawned on me that although I kind of mentioned it in the about page in Substack, I never really went through like a formal introduction. So this will be my attempt. So I've already said I'm a legal immigrant of this country. I went to undergrad at Stern NYU. I've interned at both Goldman Sachs and Merrill Lynch during my undergraduate degree. So a lot of us Sternies would go work at Wall Street and do half days in class to get experience and to compete for these jobs coming out of NYU. So the reason why I did both Goldman and Merrill, and if you're too young to know who Merrill Lynch is, think like Morgan Stanley. So they're like a brokerage house. I don't even know if you're too young to remember what a stockbroker is, but there, when you look at Wall Street, there's a buy side and a sell side. So for me, it was important to work both the buy side and the sell side. So I got exposure that way. And when I graduated, it was 99. So that's when the dot-com bubble was happening. So rather than pursue one of these jobs at a investment firm, investment banking, I chose the route of going to a tech startup. And that kind of catapulted my career over the course of decades. And I learned a lot. I grew a lot as a person, did a lot of hard work, but then also managed. And it culminated with a tech company that I was with being acquired by Adobe. And that was not only life-changing financially, but also it was just an unbelievable experience. And to have had multiple years leading up to that, and then being acquired by Adobe and having multiple years under Adobe, and boomeranging back multiple times to Adobe, I saw because I've seen bad companies and I've seen how bad managers run bad companies, but I've also seen great companies. And I think when you look at Adobe, another company that I know gets a ton of great reviews, and I've met a lot of the senior leadership there, was Microsoft. These are great companies that run their business very well. So after my stint with the global role at Adobe, I was, keep in mind, since I would say 2003 till this point in my journey, I was managing not only my own funds, but also my family's investments. And I traded through not only the .com crisis, and don't get me wrong, I learned a lot. I made a lot of mistakes during that time frame, and I remember like even cutting class at Stern, just so we all could day trade Ask Jeeves. So Ask Jeeves, if you don't know, was a search engine that competed with Yahoo and the likes of Netscape, companies you probably never even heard of if you're too young. And their stock was exploding in the late 99s and early 2000s. And, the bid-ask spreads were going crazy, just like today. It was like, you have an 11 o'clock class, you come out of that class right before lunch, and it's like it went from $180 to $230. So we're like, you know what, screw class. We're here to learn finance. We're here to learn stocks. So let's fucking trade. So that's kind of my background. And then, obviously getting more mature, trading through the end of the .com craze, then going into the great financial crisis, then the whole fat finger fiasco. I actually made money on the fat finger day. Total luck. Sometimes it's good to be lucky than good. And now through today, so 2024. So that's a little bit about me. I just realized that the name of NYU grad.substack might indicate that I just graduated from Stern or NYU. So that's not the case. So for those that didn't know, that's a little bit of background about myself. All right, good. I didn't drop too many F-bombs. But going back to today's session, right? Like, you have basically now the Magnificent Five. So Tesla, while it was green today, it is underperforming its peers. Apple is underperforming its Magnificent Seven peers. Although they were up, but I think after hours they're down handedly right now. So that's not good either. Apple right now, it's 7:09 New York time. And I'm just going to go to online and just check. Because I think they were down like 3 or 4% last time I checked. But I'll get to my point in a second. Oh, there's Zuckerberg's face. Yeah, Apple is down 3.15% after hours. Now, keep in mind, they're a great company, okay? I have nothing personal against Apple. I really don't. I think they're a transformational company, especially under Steve Jobs. I remember getting my first iPhone, which was the iPhone 3. And then my last iPhone was the iPhone 5S. And I knew when the iPhone came out, it was going to be a world-changing event. And keep in mind, I used to have a beeper in high school. I had the T-Mobile Sidekick in college. I had the Nokia phone, the StarTax. And when the iPhone came out and it became 3G compatible, and it was fast, I was like, this is it. But the reason why I'm going through this is, keep an eye on Apple, but they're becoming almost like a utility company. They're growing at scale, which is amazing, right? Because they're a $2.8 trillion company. But my question is, where is their growth going to come from? Is it Vision Pro? Are we all going to put on goggles and distract ourselves in the virtual universe? Hey, another idea that I had was, if Tesla keeps falling, if Tesla goes to $100 or sub 100, maybe Apple just buys them, right? Elon wants his shares and he wants out, just buy the company. We'll see what happens, but I think their ability to grow at this scale is going to be challenged, and they have a ton of cash. We'll see how they deploy it. Speaking of cash to deploy, I'm going to move over to Meta and Mark Zuckerberg. So this company, I keep it very PC. I keep it politically correct. I don't really put my personal emotions into the podcast because I want to be objective, because we're just trading prices. But I hate Facebook. I hate Facebook with a passion. I've worked with them. Okay, during my time at Adobe, I was servicing a lot of the Fortune 50 clients who work with Adobe and Facebook, and they grew to a point where they could dictate to the market, just like Google, what media is defined as, what news is defined as, what entertainment is defined as, and they have so much power, and they do very little to protect their users and their users' data, because the user is the monetization product. So the harder it is to share our identification, it doesn't have to be PII, personal identification, but it could be like our cookies, our browsers, our mobile IDs, our cross device history. That's how they make money. And now this company that has grown so large on the backs of all of its users is going to declare a dividend for the first time ever. And the stock exploded. The stock absolutely exploded after hours. And that's great. Like for Wall Street, for shareholders that are going to hold it long term, that is great. But enjoy the dividends while you can. Because at $452, I think that's like a PE of 40. They're going to have to really, they're going to have a hard time growing, I think, at this rate. And they know that. And that's why they are announcing this dividend, is to keep shareholders captive so that they don't sell. And they also issued a $50 billion buyback. So these are the games that are going on right now. Amazon, I have not heard their earnings call. I saw that their stock price was peaking and then falling a little bit after hours. We'll see how they open up. But, again, Amazon, Apple, Meta, these companies are so big, they're too big to fail. They're not going anywhere. But they wield so much power and control of their ecosystem. It's hard to compete with any of these companies. So with that, I want to just mention we're losing a little bit of the Magnificent Seven. It's becoming like the Furious Five. So basically Microsoft, Nvidia, Google, Meta, and Amazon. Like Apple and Tesla, we'll see what happens, but they're less and less such. And if you want me to just pick the top two, it's probably going to be Nvidia and Meta as the top two. What else did I want to cover today? The 10-year yield is crashing. We're going from like 4.1 to 3.8. And I noted yesterday on Wednesday, because yesterday both yields and stocks were down, and I said, typically from my observation, yields and risk assets cannot go in the same direction for more than 72 hours. From my observation. It's just more like, it's not like I don't have the exact data, but I watch the markets every day. I've never seen it happen for more than 3 sessions. usually what happens is one will diverge from the other. And today that's what happened. Yields kept going down, but stocks and risk assets went up. Now, the last thing I wanted to cover was on Friday. Not only do you have to watch out for how these companies open, Amazon, Meta, and Apple, you also have the non-farm payroll numbers coming out in the morning at 8:30 and the unemployment rate. I mentioned this yesterday. If the non-farm payrolls is revised last month's negatively, like, oh, more jobs were lost, and the report tomorrow says, oh, there's a ton of job losses, that may be seen as bullish, right? We are all losing our fucking jobs. That means that Jerome Powell and his friends can stop staying higher for longer. So we can continue this rally with Apple, not Apple, Meta and Amazon into tomorrow, into the close. But if the jobs number is like better than expected and we're gainfully employed and we're, the unemployment rate is decreasing, that might squash this rally, saying, oh, Jerome Powell might have to stay higher for longer. So this is the game that we're playing now. And this is the other thought I had. I watch mostly on the weekends, not on the weekdays. On the weekends, I'll try to consume a lot of content just to see what I missed. I want to always see the other side of the trade and see, because obviously I'm a human being. I have my own biases. So I try to take that out as much as I can out of trading, but I do have my biases. So I actually seek out the other side. And it dawned on me that especially like during like holiday weekends when I consume a lot of content, and I just think to myself, everyone is talking about the Fed cutting, not cutting, earnings calls, earnings, forward-looking PE ratios, and all this stuff, okay? But at the end of the day, you have to transfer your funds and hit buy and hit sell. You have to actually do the job of trading. And I don't see too many people talking about that. So why I'm bringing this up is, I think a lot about my journey, not having to work a full-time job anymore. I am 100% self-resourced now. I eat what I kill. No one pays me a W-2 anymore. I don't count on it anymore. This trading is 99% of it. And that 1% is the Substack. So when you are consuming, not just everyone else, mine included, podcasts, Substacks, YouTube, whatever, you can consume as much content as you want, but eventually you're going to have to get on that field and throw the fucking ball. So I know a lot of you are near retirement because I get emails, or thinking about when can you retire and what is going to happen after that. I am not a CFA, CFP, broker, but I urge you to arm yourself, but then start to practice. Get reps, right? Allocate a small portion of your wealth and start to learn to trade every day. Because talking about it, talking about the Fed, talking about earnings, talking about this, it's all a distraction. Like I said yesterday with the sexy jutsu and Naruto, it's all a fucking distraction. You're going to have to hit the buy button. You are going to have to hit the sell button. And whatever happens, you have to take credibility or responsibility for that. So that is the hardest part of trading. bar none. It's not the research, it's not the math, it's not the spreadsheets. It is the psychology of trading. So that's why I am doing the Substack and the podcast. I hope you listen to me every day. I promise you, you will start to pick up things and you will get confidence. You're not always going to make the right decisions, but you will learn something. And there's many ways to make or lose money in the stock market. So my methodology might not fit you. Diego Perea, who I posted the YouTube video the other day, talked about this very eloquently. Find the right trading style that fits your personality. You don't have to follow a specific method. So I hope this was valuable. I know I ranted a little bit today, but let me know in the comments what your thoughts are. And just a quick reminder, if you could click on that shout out link and shout out NYU Grad Substack as a Substack and podcast, I would highly appreciate it. I will see you all after the Friday session. All right, bye.